Every IPO process involves a plurality of investment banks working on it. Why is this necessary? Isn't it sufficient to work with a single investment bank? Well, if we have to answer this question directly, no, it is not sufficient to work with a single investment bank. There are a number of reasons for that. The most obvious reason is that certain investors prefer working with certain investment banks. The more banks that participate in the so-called syndicate, the bigger the chances of attracting important investors. At the same time, the syndicate has a clear hierarchical structure. At the top, we will have one or two banks who will assume the role of global coordinators. Their role would be to oversee the entire process and co-coordinate the various work streams. Next, we have the role of the bookrunners. Again, there can be one, two, or three banks who will be bookrunners. Oftentimes, global coordinators are also active as bookrunners in the IPO offering. Bookrunners are responsible for the entire marketing effort, the care of analyst presentations, roadshow presentations, and are the ones who manage the whole banking syndicate. Lastly, the banks which are hired as co-lead managers help with the marketing efforts of the transactions and contribute with their networking and know-how expertise. So, these are the three types of roles that investment banks can have in a syndicate. The more important the role of a bank, the more fees it'll be able to earn in an IPO. Some of the most reputed banks, like Goldman Sachs, do not accept to be hired as co-lead managers, as this would be a hit for their reputation. What is the typical breakdown of IPO commissions then? It is 60-20-20. 60% is spent for selling commissions, based on performance of each of the bookrunners and co-lead managers. The more they sell, the higher the amount of commissions that they will earn. Then 20% will be split pro rata among bookrunners for their underwriting efforts, and another 20% will be split pro rata among global coordinators for their management efforts. Right. This is the split structure, but what are the actual fees that are being charged in an average IPO? Fees are typically in the range of 1.5% to 7%, with an average of 3%. The critical factor that determines fees is size. The bigger the company, the lower the percentage that is applied to the IPO'd value. Think of a very big IPO, like the one of Facebook. Facebook was able to raise $16 billion when it became public. If we assume that fees were 1.5%, then this means that the banks in the syndicate split $240 million, a huge amount of money. This is why IPOs continue to be seen as one of the most preferred types of business for investment banks. Into three main categories: retail investors, institutional investors, and hedge funds. Retail investors are private individuals looking to invest their money in order to diversify their income and earn more money. Typically, these investors can invest lower amounts and are subject to significant transaction costs due to fees of brokerage and high bid-ask spreads. Institutional investors are entities like mutual and pension funds and insurance companies. These organizations have the resources and specialized knowledge for extensively researching a variety of investment options that are unavailable for retail investors. Some institutional investors have a very solid reputation. Attracting BlackRock and Fidelity's interest in an IPO can be a very strong signal for the market. Hedge funds, on the other hand, are investment vehicles who are mainly interested in trading with underpriced or overpriced securities. Their investment horizon is extremely short, given that they are interested in making an educated bet, profiting, and then closing their position. The three types of investors differ significantly in terms of investment horizon, return expectations, risk profile, and sophistication. Right, so these are the three types of investors. What are they looking for in an IPO? All investors want to buy the shares of a strong company, a company that has market leadership, strong management, a solid financial position, and a very high level of visibility and disclosure. In addition, investors don't want to be stuck with a given investment. They'll need liquidity in terms of a secondary market, where they will be able to sell their shares if necessary. Finally, investors want an interesting valuation. A valuation at a discount, which provides an incentive to place orders and assume the risk of buying a security that hasn't been traded before. Is there a type of investor that is preferred by investment bankers? Well, of course there is. Investment bankers like retail and institutional investors. In fact, almost always they try to allocate some shares to retail investors because retail demand creates momentum in the book-building process. Retail investors are the ones who typically hold a stock the longest, which is something very valuable. It is a banker's goal to find investors who will stick with the company. On the other hand, hedge funds will be the ones who will dump the stock as soon as they can. Investment bankers' recommendation will depend heavily on the type of investors that will come on board at a certain price level. They aim to achieve the company's objectives and ensure a stable aftermarket. Top management delivers presentations and explains what lies ahead of the company. All of this is done in an effort to determine the price that investors are willing to pay on the day of the IPO. In this lesson, we will talk about the various price-setting mechanisms. The price range which is set for an IPO depends on multiple factors. Its key goal is to provide a slight discount to the actual trading value of the company. This will keep investors happy and facilitate the post-launch trading of the shares. So, which are the main ways that are used to determine how much the company's shares are worth? Discounted cash flow valuation is the main technique that is applied in order to determine a company's price. It consists in calculating the present value of all cash flows that the company is going to deliver to its owners. The basis for this valuation are historical results and the business plan that has been prepared by the management team of the company. So, the DCF model establishes a possible price range. But what other factors play a role? Another valuation technique that is applied by practitioners and triangulates results is multiples valuation, consisting in finding comparable companies having a similar business in terms of industry, size, geography, and market strategy. Analysts use the price of these public companies and calculate a ratio between their prices and operating results. This ratio can be multiplied by the firm's operating result and thus obtain a sense of the company's valuation. As anticipated, we'll cover these techniques later in the course. It is easy to imagine why the shape of the general economic environment can be of extreme importance. Nobody wants to conduct an IPO when financial markets are turbulent and all shares are going down. Tens of IPOs were canceled in 2008 when the global financial crisis erupted. Towards the end of the IPO process, investment bankers' idea of pricing improves significantly. After each meeting with investors, they receive feedback about investors' willingness to buy shares at different price points. So institutional investors are able to tell the bank how many of the IPO'd shares they are willing to buy at different prices. This process is called book building. At the end of all roadshows, investment bankers have a very good idea of how many shares can be sold at different price points and suggest a price to the owners of the IPO'd company that is based on this information. We need to remember a few important facts. Ideal pricing is at a reasonable discount to trading value of the company. Book of demand is the most important tool in discussing pricing. Limits from anchor orders and from investors that have been heavily involved in the process are a very important signal for the optimal price. Pricing is a long and difficult discussion with the company and its shareholders. As a conclusion, we can repeat the following. Pricing should achieve the company's objectives whilst assuring a stable aftermarket. Let's take an in-depth look at the various steps that are necessary in order to carry out an initial public offering. These steps can be divided in two phases, pre-launch and execution. Naturally, we'll start by describing the various pre-launch steps. Let's imagine that the IPO process starts 6 months before the intended date of the offering. The first task that the company's ownership have is to hire advisors. Besides investment bankers, they'll need the help of legal, industry, tax, and financial advisors who will carry out a due diligence of the firm. They'll create documents describing the company's as-is situation. In 90% of the cases, companies have a pre-existing relationship with the investment bank that they hire. In an ideal world, bankers have been the firm's trusted advisors for a long time and have helped the company grow its business and go public, have given a signal that the time for an IPO has come. So, once all advisors have been hired, they will define the key issues that have to be addressed by the firm. Are there any legal problems that have to be addressed before going public? Is there a particular topic that is likely to concern investors? How solid is the company's financial reporting system? Is everything coherent with IFRS or US GAAP? These are some of the topics that come out when advisors carry out their due diligence. At this moment, investment bankers work closely with the company's management team and prepare their first valuations using the techniques that we described earlier. The prospectus is one of the critical documents in an IPO. Typically, it is very heavy and exhaustive, describing almost all aspects of a company's business. This is done in an effort to protect retail investors. They are less sophisticated than professional investors and need access to a descriptive document that enables them to make an informed decision. The final version of the prospectus should be ready in approximately 2 to 3 months before the company's listing on the stock exchange. The next few processes are a part of the execution phase of the IPO. 1 or 2 months before the IPO, investment bankers and top management start their roadshow, meeting with investors, answering their questions, and trying to win the support of key investors, like industry experts, reputable funds such as BlackRock and Fidelity, and retail investors. At the end of each of these roadshow meetings, investment bankers ask investors for feedback regarding their interest and the price they are willing to pay for the company's shares. Once the roadshow and book-building processes have been completed, bankers gain an idea of how many shares and at what price they will be able to sell to investors. They advise the company's ownership on how to allocate shares between the various types of investors. The main goal here is to get quality investors on board, investors who will stick with the company after the IPO and will thus support the price of the shares that are listed on the stock exchange. And finally, the last stage of the process is the actual listing of the company's shares and the start of their trading on the stock exchange. These are the typical steps that we have in an IPO. In our next lesson, we will learn that, in reality, there is a syndicate of investment bankers that work on an IPO. This will do for now. Thanks for watching.